There is a very specific, powerful script that has been carefully handed down to us from our parents, passionately preached to us by our grandparents, and reinforced at every turn by the culture surrounding us. This doctrine is reinforced by every single real estate agent with a beaming, smiling face plastered on a bus bench in your neighborhood. It is called the American Dream, the ultimate marker of true adulthood and the supposed golden ticket to achieving middle-class wealth. The script tells you quite clearly, rent is nothing more than throwing money away. You are told that by renting, you are simply paying your landlord's mortgage instead of building your own. Buying a house, they claim, is the best investment you will ever make in your entire life. We internalize this doctrine until it becomes a core part of our identity. We often feel a deep, visceral shame when we find ourselves still renting at 30, as if we have failed to launch, or as if we are financially illiterate children who are simply refusing to grow up. In a state of social pressure, we panic and buy homes that we can barely afford. We stretch our debt-to-income ratios to the absolute breaking point, fully convinced that we are making a brilliant financial decision simply because we signed a deed and own a set of keys. But I am here to tell you that for millions of people in the modern economy, this script has become a lie. The math has changed, the market has fundamentally changed, and this blind faith in homeownership is trapping an entire generation in a prison of illiquidity and stagnation. The uncomfortable truth is that for many of you watching this, your house is not an asset. It is a liability. It is a massive, leverage-fueled consumption purchase that is currently masquerading as a sophisticated investment. My name is Kyle, and I spend far too much time running the complex numbers that the real estate industry hopes you never see. If you are someone who feels the heavy pressure to buy, or if you are currently house poor and wondering why you do not feel rich despite owning a home, make sure you hit that subscribe button right now. Today we are going to dismantle the rent versus buy myth piece by piece. We are going to thoroughly expose the unrecoverable costs of homeownership, the very specific money you throw away that is, in reality, mathematically identical to paying rent. We are going to accurately calculate the price-to-rent ratio. This is the single most important metric for deciding exactly where you should live. And I'm going to show you how a disciplined renter who consistently invests the difference can often end up with a significantly higher net worth, far more personal freedom, and substantially less stress than the homeowner who is permanently chained to a 30-year mortgage. To understand why buying is not always better, we have to completely redefine what throwing money away actually means. When you buy a house, you are told that your monthly payment is savings or equity. This is false, especially in the early years. A massive portion of your monthly housing cost as an owner is also thrown away. It is money that never comes back to you. First, there is the cost of capital, primarily mortgage interest. In the first few years of a 30-year mortgage, nearly 70 to 80% of your monthly payment goes straight to the bank as interest. You are not paying yourself. You are simply renting money from the bank. If you actually take the time to look at a standard amortization schedule, it is truly terrifying. You might faithfully pay $3,000 every single month, but only a measly $400 of that payment is actually reducing your total debt. The rest of that money is simply vapor. It is gone forever. Second, there are property taxes. This is essentially a perpetual rent that you must pay to the government for the simple privilege of staying on your own land. In states with high taxes, this cost alone can easily equal a modest monthly rent payment. Third, there is maintenance. The general rule of thumb says this will cost you between 1 to 2% of the home's total value every single year. This is not for fun renovations. It is for the unsexy stuff like broken water heaters, leaking roof patches, and expensive pest control. Fourth, you have to pay for homeowners insurance. And fifth, there are the massive transaction costs involved in buying and selling, which can ruthlessly eat up to 10% of the entire asset's value. When you add all these up, the interest, the taxes, the maintenance, insurance, and fees, you often find that the unrecoverable cost of owning is nearly identical to the cost of renting. You are not building wealth. You are simply paying a different landlord, one comprised of the bank, the state, and the local hardware store. The ultimate math of this incredibly difficult decision usually comes down to one single critical number, which is known as the price-to-rent ratio. You should think of this essentially as the price-to-earnings ratio, or the PE ratio. specifically for the housing market. You calculate this ratio by simply taking the total purchase price of a home and then dividing it by the total annual cost to rent a remarkably similar home in the same area. Let us look at a real example. If a house costs $500,000 and that same house rents for $2,000 a month, which equals $24,000 a year, the resulting ratio is roughly 20. Historically speaking, a ratio below 15 suggests that it is generally better for you to buy. However, a ratio above 20 suggests that it is arguably much better for you to rent. In many major global cities today, such as Toronto, San Francisco, New York, and Sydney, these ratios are pushing 25, 30, or even significantly higher. When the ratio is that high, the cold hard math is practically screaming at you to rent. Why exactly does the math favor the renter when the ratio is so high? It is because the sheer cost of capital required to support that massive purchase price far exceeds the monthly cost of rent. By choosing to rent in this specific market, you are effectively and strategically shorting the housing market. You are living in a prestigious $1 million asset for only a tiny fraction of the total cost it would actually take to finance it yourself. You are allowing the landlord to effectively subsidize your daily lifestyle while they take on all of the significant financial risks. While you enjoy the space, the landlord is the one responsible for the terrifying possibility of the boiler suddenly breaking, the foundation unexpectedly cracking, or the entire local real estate market crashing overnight. You are consuming high-quality housing services at a massive discount, while the owner is desperately speculating on a future appreciation that may or may not ever actually happen. But the most dangerous trap of homeownership is the opportunity cost of the down payment. This is the invisible wealth killer that absolutely nobody ever talks about at dinner parties or social gatherings. To buy that $500,000 home, you likely need to put down a full $100,000, which represents 20% of the total price. That is $100,000 of cold, hard cash that is now physically locked inside a literal wall. This is what financial experts call dead equity. It produces absolutely zero monthly cash flow. It cannot be easily accessed to buy your weekly groceries. It cannot be strategically rebalanced into other sectors. It is, quite simply, trapped. If you find yourself in a financial pinch, you cannot simply go to the store and pay for your necessities with a piece of your kitchen wall. By locking that $100,000 into the house, you have traded your liquidity for a stationary pile of wood and brick. Now, imagine for a moment if you had instead taken that same $100,000 and invested it into the S&P 500, which has a long historical track record of returning 10% annually. Mathematically, that investment would double in value roughly every 7 years. In that scenario, your money is working for you around the clock, growing exponentially, whereas in a house, it is simply sitting there, buried in the structure. By locking your capital into a house, you are essentially placing a massive, concentrated bet that your one single specific local real estate market will somehow outperform the incredibly diverse global stock market. It is a gamble that, historically speaking, real estate almost always loses. Robert Shiller, the Nobel Prize-winning economist, has definitively proved that over the course of the last century, real home prices have barely outpaced the rate of inflation. The massive gains that people love to talk about at parties are usually just simple inflation illusions or the result of leveraged luck in very specific bubble markets during very specific decades. It is not the reliable wealth-building machine that the industry wants you to believe it is. By choosing to rent and instead investing that original $100,000 down payment, plus the monthly difference between your rent and ownership costs, directly into the stock market, you successfully maintain liquidity, diversity, and a much higher expected rate of return over the long run. This is known as the rent and invest the difference strategy. And for disciplined individuals, it acts as a massive wealth accelerant. It successfully turns you from a house-rich, cash-poor prisoner into a truly liquid and flexible millionaire. We also have to discuss the critical concepts of liquidity and mobility, which are frequently undervalued assets in our modern world. In a very real sense, your house acts as a heavy anchor. In a rapidly changing and volatile economy, the simple ability to move quickly for a significantly better job, a lower cost of living, or a much better lifestyle is a massive, tangible financial asset. Imagine you suddenly receive a prestigious job offer in another city that pays you $50,000 more per year. For the person who is currently renting, they can simply pack up their belongings and leave in 30 days with absolutely minimal friction. They are free to chase that opportunity instantly. The homeowner, however, is fundamentally trapped. They must undergo the grueling process of selling the house, paying 6% in agent fees, paying expensive closing costs, staging the entire home, and potentially even selling at a significant loss if the local market happens to be down. The massive transaction costs of selling a home can easily wipe out several years of accumulated equity in a single afternoon. By buying, you are essentially shorting your own mobility. You are placing a massive bet that your current location will remain the absolute best place for you to be for the next 7 to 10 years. If you happen to be wrong about your location, the exit fee is absolutely brutal. Renting buys you optionality. And in an increasingly volatile world, that optionality has a very high premium value. Now, I can already hear the objection, the one that everyone yells in the comments. But Kyle, rent goes up. My mortgage is fixed. This is true, and it is undeniably the single strongest argument for buying. A fixed-rate mortgage is indeed a very powerful hedge against inflation. But you must remember that while the mortgage principal and interest payment might be fixed, absolutely nothing else in that equation is. Property taxes go up constantly as local municipalities search for more revenue, and insurance premiums are currently skyrocketing due to increasing climate risks. The reality is that you are not at all immune to inflation. The cost of labor and the specialized materials required to fix your roof or repair your plumbing goes up significantly with inflation. You are not actually protected. You are just exposed to inflation in different and often more expensive ways. And while it is true that rent goes up, it is equally true that the stock market goes up as well. If your investment portfolio, which you have funded by the savings from renting, grows at 7 to 10% a year, it will likely far outpace the typical 3% annual increase in rent. This allows you to use your appreciating financial assets to pay for your lifestyle, rather than using your primary residence, the place where you sleep, as your only significant asset. The specific gap between your high investment returns and your smaller rent increases is often exactly where the disciplined renter wins the financial game in the long run. There is also a profound lifestyle element here that almost always gets ignored in those clean, clinical spreadsheets. Homeownership is essentially a part-time job that you never actually applied for. It is entire weekends spent wandering the aisles of Home Depot and fixing leaks, instead of spending that precious time relaxing with your friends. It is the sudden, sharp stress of hearing a strange, mechanical noise in the basement in the middle of the night and knowing with absolute certainty that you are the one who has to pay for it. You cannot just ignore it. It is your responsibility and your financial burden alone. There is a heavy, constant mental load involved in managing a deteriorating physical asset. A house is in a perpetual state of decay, fighting against the wind, the rain, and time. Keeping it standing and functional requires your constant attention and mental energy. When you choose to rent, you are effectively and strategically outsourcing all of that structural stress to someone else. You are buying your time back. If the dishwasher suddenly breaks, you do not panic. You simply call a single number, and the problem is fixed for you while you continue with your day. That specific time freedom has a profound value that rarely shows up on a bank statement. It is the luxury of not having to worry about the physical infrastructure of your living space, allowing you to focus your energy on growth and happiness. If you take those Saturday mornings and use them to learn a new high-value skill, launch a side hustle, or simply relax and recharge, you might discover that renting actually increases your total income potential. You are no longer constantly distracted by home maintenance. You are effectively trading the hollow pride of ownership for the true luxury of freedom. Many people rush to buy a house fully convinced it will provide them with ultimate stability, only to find that it actually produces a constant state of underlying anxiety. Now, I am certainly not suggesting that you should never buy a home. Buying can absolutely make perfect sense in very specific scenarios. If you are planning to settle down in one specific location for 10+ years, if you truly value the ability to renovate and customize your living space more than you value liquidity, And if the price-to-rent ratio in your area actually favors the purchase, then buying is a viable path. But you must not buy simply because you believe it is a mandatory, scripted step to achieving wealth. Do not buy because you are terrified of throwing money away on rent, while you simultaneously ignore the massive amounts of money you throw away on mortgage interest and property taxes every single month. At the end of the day, a house is a consumption choice, much like a fancy sports car or a very nice suit. It is primarily a place for you to live and build a life, not a guaranteed or foolproof retirement plan. If you treat your primary residence as your primary investment, you are creating a highly concentrated, illiquid, and expensive portfolio. You are essentially one natural disaster or one unexpected neighborhood decline away from total financial ruin. The true path to wealth is not about owning a piece of paper or a deed. It is about owning income-producing assets. Stocks, bonds, and businesses are assets that actually pay you. A house, conversely, is an asset that you pay every single month. Do not let the outdated cultural script bully you into making a bad investment. Run the numbers yourself. Check the price-to-rent ratio. Look closely at the unrecoverable costs. And if the math says rent, then you should rent with absolute pride. Invest the difference, build your own liquid empire, and let the landlord be the one to worry about the leaking roof. Hit like if this video has made you completely rethink the American dream. Follow Kyle for more strategic ways to hack the system, ignore the social pressure, and build real wealth on your own terms. I will see you in the very next one.